There's an overwhelming amount of financial advice in the news and on social media. Who do you listen to? Are they looking out for what's best for you? How do you tune out the noise? In this podcast, trusted advisors Emily Agosto, CPA, and Amanda Vaught, JD, bring their extensive education and experience to delve into all aspects of personal finance. Emily and Amanda make topics like investing, taxes, and financial planning interesting and accessible. And they provide a framework to help you think through the plethora of financial advice and news out there. Are you ready to start making the best personal financial decisions for you? Welcome to Connecting the Dollars with Propel Financial Advisors.
Hello, welcome to another episode of Connecting the Dollars. We are recording this on May 2nd of 2024. So that means Amanda and I have survived another tax season. And so on that note, today we want to talk about some lessons learned, specifically 10 lessons learned from this tax season. We're going to go over some kind of general things, some more specific things having to do with both individual taxpayers and also business taxpayers. So let's jump right in. So number one.
Okay, go for it.
Are you ready? Number one is under withholding for your tax burden.
Yes.
We see that
always a problem, right?
Yes. And it's just one of those things that it's really hard to wrap your mind around when when you're a contractor, when you're a W-2 employee, either one, whether you're a small business, it's hard to determine, it's hard to know, like, why do I have to pay 25% of this? Or like, why am I sending this to the government? But
yeah. I think under withholding, it's always a problem, but I think it's more of a problem this year and last year as well, after interest rates went up a lot, because if you're under withholding the tax on your paychecks, or if you're a 1099 or a freelance employee, and not doing proper withholding, the interest rates and penalties on that tax has gone up. So the consequences for it have gotten more significant than they have in the past.
That's true. Because on interest, like 1099, INT is the form, you don't even have the option to withhold anything. You don't really have the option to do extra withholding on those forms. So it's something you have to keep track of on your own and plan for.
Yeah. And I just want to do a general educational statement, is that your income tax is due when you earn the income. And then the IRS sets these quarterly dates where you can make your estimated payments on amount earned during that quarter. A lot of people have this belief that tax is due on April 15th. And that is the date the filing is due.
Right.
That's not the date your tax is due. So right. Just something to keep in mind.
Yeah, and that actually is a good segue into the second lesson learned. And this is on the business side of things, or sole proprietor side of things, estimated tax payments. So yes. As Amanda said, they're due every quarter. And it's kind of a little tricky too, because for seasonal businesses, it doesn't really work out. Like for our tax firm, like we probably make, a larger percent of our income during the second quarter. And so we still can, you would technically, okay, so I'm getting confused is because our firm is actually taxed as a C Corp, so we don't actually have this issue. But if you are a sole proprietor doing tax work, and you made most of your money in the second quarter, you would have to pay a larger chunk in the second quarter, you would think. But then once you do your taxes, the IRS is going to be like, you didn't pay enough in the first quarter. So it's just annoying, but it's more important to make payments on those quarterly dates rather than, I'm rambling here, instead of not making the payments and just paying at random times.
Right. Yeah. Yeah, and there's different ways you can avoid the penalties, right? For under withholding, or for making your estimated payments. You can do, there's safe harbor provisions. You can base it on the income you earned the previous year,
Right.
which can help for somebody who might have a variable income throughout the year.
Yes.
That makes it harder to calculate or sort of as you go along. So there are different ways you can do that. And so those are great questions and issues to bring to your tax professional and say, what's the best way,
Yeah,
or your financial advisor and say, I'm having trouble budgeting for this. And, there's ways we can work through these things.
absolutely. All right. What is number 3 here on the list?
Oh, getting married
Yes.
or divorced or widowed.
Yeah. So
Right.
when you're switching from any status to another status, so when you get married, you're switching from a single status to a married filing jointly status. If you're widowed, unfortunately, you'd be going from married filing jointly to single after the year your partner passes away. And that was actually something that I saw a few times this year that we know, how it works, but when you actually see it happen in front of you, it can kind of take you by surprise. So
Yeah.
I was doing a tax return for a recent widow, and he was the one who brought in most of the money and a pension and his Social Security. And so when his wife passed away, all of a sudden he still had the same income amount, but he was in the single status, which was a much lower standard deduction. So that was something he had to work around and plan a little bit extra for.
Yeah. Yeah. And it's hard if you're a widow, to deal with financial things. The last thing
Right.
you're thinking is the tax impact of
Mhm.
the loss of a loved one. I mean, but it can really take people by surprise, unfortunately, the financial consequences of moving from married to single taxpayer.
Right. And on the flip side, yeah, when you're combining taxes, that can be very confusing as well.
Yeah, yeah. And a lot of couples, you can incorporate that tax planning into your conversations. I know everybody's like, you need to have, money conversations with your partner. That's tax consequences can be part of that as well.
Mhm.
Whether it's better to do married filing jointly, married filing separately. These can impact not just your tax rate, but for example, the amount of money you can contribute to a Roth account. Um,
Right.
the number of deductions you can claim, right, changes between married filing separately or jointly.
Mhm.
It can impact your state return. There's all types of different impacts you see from those decisions. So
Yep. All right. Should we go to number 4?
number 4, yes.
Okay. Number 4, we have charitable donations. So, since the Tax Cuts and Jobs Act of 2017, where the standard deduction was increased, a lot of people are taking the standard deduction who used to itemize and can no longer deduct charitable um, contributions. So we're talking about both cash and about, giving away furniture, clothes, and whatnot to Goodwill.
Mhm.
Something new that came up kind of like in the middle of tax season this year, the IRS is going to be requiring signed receipts from anywhere that you'll donate goods to. It has to be a 501c3 registered business or
Nonprofit
what am I trying to
organization.
say? Organization is the word. Thank you.
Yeah.
And in the event of being audited, the IRS is going to ask for these signed receipts. So I know in the past, like I've donated things to the thrift store down the street and sometimes they don't even give you anything, but they'll just give you like a sheet of paper that's blank. So
Mhm.
now it's the burden's on the taxpayer, like it always is, to be like, hey, can you sign this? And can you write out the description of what's being donated so that you can properly take that deduction and in the event of an audit, still be able to substantiate it.
Yeah.
Was that it on that one?
Yeah. Yeah.
Okay.
I think it's just an important change for people to be aware of.
Yeah.
The next one, number 5, is a change that's supposed to be happening, but keeps getting pushed back by the IRS.
Mhm.
That is the $600 limit on transactions that we typically see on Venmo or PayPal type of platforms, right, Emily?
Yeah. So if you use Venmo for a business, like you're actually selling things, the Venmo is supposed to send you this 1099K if it's over $600 and saying you earned, let's say, $800 of business income, and then you're supposed to report that on your tax return as business income. So I did see PayPal's reporting those more now, it seems, but I don't know. It's been a big mess since the IRS tried to implement it in 2022. They keep kicking the can down the road. So it may or may not ever happen, but it's important to know about it because if you're not prepared and it does get, put into effect, it could really
Mhm.
affect your income taxes.
Yeah, yeah. So I tell people if they do use Venmo or PayPal or another cash app, whatever,
Mhm.
to really take advantage of the memo line and keep good notes about what the transaction is for. Because if you
Right.
go out to a fancy dinner and say you Venmo somebody more than $600 to cover the bill, um, you don't owe income tax on that. That's
Right.
not a taxable event. But if you receive a 1099K in the mail saying you're going to owe income tax on it, it'd be nice to have a record to say, look, this is just a friends going out for dinner thing, not, because I sold stuff on
Yeah.
eBay or something, right?
Right.
It's different types of transactions. So keeping a good record of those is smart, whether or not the IRS implements this update.
Yep, for sure. The sixth topic is owing income tax based on the interest you receive. We already kind of mentioned how interest rates have increased and you may be receiving interest on your checking account or savings account, and you're not necessarily able to plan for that if you're not keeping track of it. So,
Right.
Amanda, what would you say to a client who's surprised about this interest income and why they have to pay tax on it?
Oh, yeah. Well, interest earned from your checking account, savings account is taxed at, your income tax rate. I think some people miss this because for the last several years, you haven't been earning any significant amount in these types of accounts, but with interest rates up, you are earning more. And whether you earn a little or a lot, that counts as income that you need to claim on your tax return. And also, there's been a shift from mailing these documents to making them available online.
Mhm.
And people forget, oh, I need to go in and log in and download this tax document. And then include it on your tax return. And then if you forget, and you file your tax return, guess what? You can get a letter from the IRS. And I would say probably across the board, nobody likes getting letters from the IRS
No,
saying that there's some problem with your tax return.
you don't want to be on their radar. You just want to
Yeah, no, let's
float
stay off
on
the
by.
radar. Yes, and they might just say we recalculated your tax return for you to incorporate this number, and then you owe this much income tax on it, plus interest and penalties.
Yeah.
Which it's a silly mistake that is easily avoided, and that great interest rate you're getting, quickly gets eaten up by the penalties you owe to the IRS because you forgot to include it on your tax return.
Yeah,
Um,
that's a
so
good one.
yeah, yeah. Also, this is a little, side comment on that is that interest you're earning from your bank account, there are tax planning approaches you can take to that, like buying treasury bonds or municipal bonds directly that can reduce your tax bill on that interest income. And so that's a tax planning opportunity that I think more people can take advantage of than I see.
Yeah, for sure. Okay. Number seven is one that is again, every year, this is something that affects someone and creates stress for people, whether you're getting your taxes prepared or doing them yourself, don't procrastinate on it. I have some people that right when they get their W-2 in January, they're like, here it is, let's get it done. Whether they owe or not, they just want to get it done.
Yeah.
And then other people who, maybe they have to wait for a K-1 or they have to wait for their 1099-R. So they're not worried about it. But in my case, professionally, as a tax preparer, I will always prefer people to just upload their documents as they come. Just keep an eye on it, keep it in the back of your mind, because, by the time you get your 1099-R, maybe in like mid-March sometimes, or your K-1's probably not coming till April even. It'd be like, oh yeah, where was my W-2 that I got, on January 25th or whatever. So
yeah, coming up with a system, keeping everything organized, uploading it to your tax preparer, uploading it to yourself, whatever system, works for you, develop one and have one. I don't think people doing their taxes at the last minute are going to run into tax professionals who don't have the capacity to help you.
yeah.
Because like we mentioned earlier, the tax filing deadline is April 15th. You can easily extend that. That doesn't change anything as far as the filing. But it does impact you because you can't change the date that the taxes due.
Right.
So if you do file an extension, you can pay money with the extension. And how are you going to know how much you owe if your professional is at capacity and can't help you? Or for me personally, this year, my kids got a horrible virus like a week before the tax deadline, and that can knock you out. And you don't want to be doing your tax last minute if you're very sick. Things happen, right?
Yeah, for sure.
Let's just not do that. And do what you can. But
yeah, and an extension is not a bad thing. It happens all the time, but if you can at least be prepared for it, or give your tax preparer what you have so they can come up with an estimate for you, that's something they could manage to do usually. Well, I'll speak for myself. We can usually manage to do it. It's not,
you're right.
Yeah, it's not great to do it at the last minute, but it at least can get you, help you avoid some late payment penalties.
Yeah. And doing things last minute, right? That's leads to mistakes. Your tax professional is probably very tired at that point.
Yes.
You don't want them to be doing your taxes last minute. You want them to be filing an extension. And it's easily avoidable.
Right.
So, okay. So I think we could go on a long time about getting tax documents at the last minute, because that's always an issue. So
Yes.
But anyway, let's move on to number 8, which is the upcoming sunset of the Tax Cuts and Jobs Act.
Right. So in 2017, the Tax Cuts and Jobs Act was enacted. Is that the right word? Sure.
Yeah.
Passed. And a lot of the provisions in that tax bill are sunsetting on for tax season 2025. So we weren't really thinking about this, at least I wasn't thinking about it too much, in the last few years, because we're like, oh, we have time. But now, we're already planning for tax season 2024, and some of the specific business changes that were put through in that act are somewhat significant. A lot of them are due to talk about depreciation and whatnot, but also the tax tables, they were changed a lot in that act. So it's very possible that those will change again. And, you could go.
The salt tax is a big one. Right?
Salt tax is a big one.
Because I do taxes for New York, a lot of New York. Emily's in Chicago, so she's a lot of people who are impacted by that.
Yeah, that's a huge one.
Yeah. So.
Yeah, just something to keep an eye on.
Taking place now, right? But for a lot of people, it really depends on the person, right? For a lot of people, they did see a reduction in their tax bill because of the changes in the tax tables, right? that may or may not be going away. You just don't know.
Right.
There is a chance that right now you are in a lower tax bracket than you will be in a few years. And, is it a good time to take advantage of some tax planning while you're in a lower bracket? Is a good question to ask yourself, your tax professional, your financial advisor.
Yeah, there's a lot of things that we can't control, so
Right.
trying to focus on the things that are likely not going to change, like your interest is always going to be taxable. I don't see that changing ever.
Yes.
So yeah, planning for those things
Yeah.
is a good idea.
Yes.
Okay, we've got two more, and they're kind of related to each other. So number 9, we're on 9. Wow, tax
Yes.
gimmicks that you see, I don't know, on Instagram or you hear on the radio. Someone promising to get you more money back, guaranteed. What do you have to say about those?
Those are tough, right? I think nobody wants to pay more tax than they have to, right?
Right.
Nobody wants to feel like they're missing out on some kind of tax loophole that some other person gets to take advantage of, but somehow they
Mhm.
have to owe all this tax. I'm sympathetic to that feeling. At the same time, there's a right way to do things and a wrong way to do things. And if you do them the wrong way, um, and the IRS comes after you, either through an audit or a letter, these decisions you make as far as deductions or strategies you take, you have to be in the position to defend them
Right.
potentially in audit, which takes time and money and resources and potentially a lawyer, or an accountant who will charge you extra for defending you in an audit.
Yep.
Um, and so you have to think about, first of all, if it does apply to you, is it even worth it, in the event that it's questioned, that
Right.
is it worth saving $200 on my tax bill if it will cost me $2,000 in legal fees? No. So anything that's a little bit questionable, you really want to ask yourself that.
Yeah, and it goes back to like making sure you know who your tax preparer is. Like we do, quick intro calls with people, but people can find out a lot of information about me on our website or,
Yes.
you know,
Yes.
get referrals. You can always ask for referrals from a new tax preparer.
Mhm.
Um, and if you do have someone coming to you saying like, "Oh wow, I can get you like $500 back easily," like maybe they can, but they may be taking a very risky position or using a very risky strategy.
Mhm.
Um, as Amanda said, in the event of an audit, like you will have to defend and you'll have to show records and saying, "Oh well, I paid this guy $100 and he told me to do this." Like that's not going to cut it. The burden will fall on you, the taxpayer, to be able to
Right.
defend it. They don't care about whoever told you to do it because at the end of the day, it's your return and you're
Yeah.
responsible for it.
Plus penalties and interest.
Exactly.
And you do hear, I did what on Twitter, I read this horror story about this tax preparer who said he filed their returns. The person paid the person to file them, and the tax preparer did not file them.
Mm,
And the person had more than 3 years of tax returns that were never filed because they had hired some fly-by-night tax preparer to do their tax returns, which is awful, right?
yeah.
Because
Yeah.
the consequences are on the taxpayer. So it's
Mhm.
important to educate yourself and take responsibility for some of these decisions.
Yeah. If it sounds too good to be true, probably is.
Yes, yes.
All right.
Um, which leads us into number 10, which has been in the news more lately, which is the employee retention credit.
Mhm.
Like I would say it's like the fallout, because that was a provision from a few years ago during the coronavirus pandemic, where the government offered relief for small businesses who kept employees on the payroll. But there are different conditions you needed to meet in order to claim that credit.
Right. It's
And there
a
were,
big mess.
go ahead.
I was going to say it's a big mess.
It's a big mess. They paid out more than $1 billion, I read. And there were a lot of outfits who would call people, like spam calls saying, let us file this for you. Let us file this for you. You can get this much money from the government. And people said, okay, you know. And now those operations who were filing it, those, they're gone. They they folded. And now the IRS is coming after the taxpayer saying, you claim this credit, we don't think you qualify.
Right.
Oh, send us the money back.
Yeah. And that's, some places got a ton of money. And to be honest, a lot of my clients that I looked into it for, there was one little thing that made them not qualify. And because there were a lot of specific rules that you had to follow to be able to see if you could get that money back, if you were eligible. And maybe you had like 5 out of 6. I don't know exactly remember how many provisions there were, but maybe you were close. And so you're like, okay, let me just do this. And that really sucks that people were taking advantage, because this is, the ERC was something new, essentially. I mean, there may have been things like that done in the past, but at least in any recent years, this is the first time we've seen something like that. So people don't have anything to look at and say, am I doing this right? They are just relying on these people telling them, hey, you qualify, let's do this. It's a shame.
Yeah, I think sometimes it's unfortunate that the system is that way, but also that is the system that we're working in. So I don't know. What are you going to say about that?
Right.
So I think that was a good list, Emily. Hopefully our listeners learned something. We usually this is Propel Financial Advisors. We're both financial advisors, but we both have separate tax practices that we like to help people, get through these kinds of things. And so.
Yeah, this was a nice little like post-mortem wrap up for us. Kind of cathartic. But yeah, hopefully, there'll be things you can think about. I mean, if you're not already tax planning and you owed a lot of money this year, start tax planning like right now, because by October, you'll be so happy that you got on track. And then the next several years, hopefully the rest of the years that you're paying taxes will be a breeze.
Forever.
Yeah, forever, unfortunately. All right, well, send us any questions, info@connectingthedollars.com. Find us at propelfinancialadvisors.com. We're easy to get in touch with.
Yes, and we have to say none of this was tax advice. Always ask your tax professional.
Yes, for sure, definitely, agreed. All right, well, thanks, and we'll talk to you next time.
Okay.
Bye.
That will do it for this episode of Connecting the Dollars. Nothing discussed in this episode should be considered legal, financial, or tax advice. If you like what you heard, please subscribe for more at Apple Podcasts or wherever you get your content. When you do, please give us a rating and a review. To see the links we mentioned in our show, along with other great Propel Financial Advisors content, go to connectingthedollars.com. You can find our past episodes there and subscribe to our newsletter. And if you're still here because you have a general question, you can email us directly at info@connectingthedollars.com. Or if you're interested in working with us, click the Schedule a Consultation button on our website. Thank you for listening.